Jerome Powell just made a move that could ripple through our entire housing market. The Fed officially cut rates, and the big question is, what does that actually mean for you if you're buying or selling right now here in Redding or even the housing market as a whole? Hey guys, welcome back to another episode of Rooted in Redding. I'm Faith Barrett, your local guide to everything here in Redding, California. If you're new to the channel, don't forget to hit that subscribe button, like this video, and comment below your thoughts. We share weekly videos about Redding and the housing market as a whole. So last week, Jerome Powell and the FOMC announced a 0.25% rate cut, bringing the federal fund rate down to 4% to 4.25%. This is the first cut since December, after months of holding steady while inflation stayed elevated and job growth pretty much slowed down. So why the Fed cut? Well, Powell described it as a risk management cut, not reacting to a recession, but trying to get ahead of the cooling job growth and rising unemployment. He also left the door open for more cuts later this year, potentially 2 more, if the economy continues to soften. So here's where it gets surprising. After the announcement of the federal fund rate cut, mortgage rates actually went up. As of September 23rd, the 30-year fixed national average is a 6.38%, up from 6.37%. The 15-year fixed rate is about 5.67%, up from 5.58%. And so instead of relief, the buyers saw a small but noticeable increase. So why did the rates rise? Well, rates actually drifted lower in the weeks before Jerome's announcement, as investors anticipated the Fed would cut. But once the cut happened, rates reversed, and most people ask, well, why? Well, the cut was already priced in. Traders expected the move, and some were hoping for a bigger surprise or a more dovish guidance. When that didn't happen, they sold the news, pushing yields higher. Second is that inflation worries resurfaced. Jerome admitted inflation may not fully return to the target until 2028, which spooked bond investors. Number 3 was uncertain paths for future cuts. There was mixed signals from the Fed's officials, which left the markets uneasy. Some say there might be 2 more cuts, some say they're not quite sure. Number 4 is new economic surprises. Stronger than expected housing data added fears of renewed inflationary pressure. And finally, the short versus the long-term dynamics. The Fed controls short-term rates, but mortgage rates follow long-term yields. So if the investors worry about future inflation, those rates can rise even when the Fed is easing. So bottom line is, mortgage rates respond not just to what the Fed does, but to how credible markets think the Fed's path forward is going to be. Okay, so let's talk about affordability and home prices. On the pricing side, most national forecasters, Fannie Mae, the Mortgage Bank Association, and the National Association of Realtors, see prices holding firm or even rising slightly through year-end due to persistent demand and limited resale inventory. But not everyone sees the same story. One expert we follow pretty closely is Ivy Zelman, and she is one of the most respected housing analysts in the country. And her outlook is a little bit more nuanced. Zelman expects the rest of 2025 to bring only modest growth, with affordability still stretched and rates staying higher for longer. She predicts new home sales will grow about 5% per year in 2025 and 2026, though builders remain cautious because of cost and oversupply. Now, looking further out, she sees that the national home price is dipping about 8% in 2026, particularly in oversupplied markets in the Southeast and Southwest, before recovering in 2027 as inventories rebalance. This means opportunities could open up in some regions where inventory is climbing, while tighter supply markets like much of the West Coast and Northeast remain more stable. For buyers, that could really mean temporary price relief in certain markets during 2026. For sellers, it's a reminder that today's stability isn't guaranteed if supply outpaces demand. So long-term though, Zelman does expect a recovery once excess inventory is absorbed. Now, Zelman lines up with many other economists who say we may see a gradual easing in rates and activity in 2026, but obviously affordability will remain the biggest challenge. Some even warn we won't consistently see rates below 6% until inflation truly cools or the economy slows more dramatically. So whether you're buying or selling, the takeaway is this: the next 18 months will likely be a slow improvement with regional differences, not a sudden nationwide housing reset. And if you are somebody who missed our market recap for August here in the Reading area, go back a few weeks on the channel where we broke down how our local market is shaping out, what opportunities buyers are seeing, and despite higher inventory, the data around sold inventory for sellers. We'll be keeping obviously a close eye as we're closing out September and rolling into November to really analyze those September numbers and see how we are in line with what we're discussing today. So at the end of the day, Jerome Powell rate cut is just one piece of the puzzle. Mortgage rates don't follow the Fed directly. They follow the bond market, inflation, and investor psychology. So if inflation keeps easing, we could see relief, but for now it's slow moving, wait and see kind of environment. And something that I talked about a few weeks ago is as Jerome steps away from his chair in May of next year, it'll be very interesting who actually takes his spot, because I personally think, and this is just my prediction, I personally think that if it's somebody who is more pro in cutting rates, the market could be a little bit different next year than what a lot of these people are forecasting based on who's controlling the federal fund rate. Overall, we will always be keeping a close eye so that you can make an informed decision here in our area, especially if you're considering making a move. As always, thanks so much for tuning into this week's episode of Rooted in Reading. Don't forget to hit that like button, subscribe to the channel, and comment below what you think your thoughts are. Do you think rates are going to go up? Do you think they're going to stay the same? Do you think we're going to be below 6% by the end of the year? Who knows? Time will tell. As always, we'll catch you next week.